there's a lot we still don't know about this new variant, and yet the market seems to have made up its mind that it is very, very bad news. Is this being overdone?
Well, I think it's hard to say, right, because we don't have a lot of data, and it's very possible that if this is a really severe variant and it starts to be able to evade vaccines, that this actually sets us back quite a bit. And what I worry about a lot is how structural will the changes be that impact the market? Do we have a situation where, dual income families suddenly switch to single income families because, a parent wants to stay at home? That has an impact, a ripple impact on the economy. So I think it's important to keep in mind what is going to be temporary and what's going to be more structural.
On the flip side of that, if we do see weakness in the economy, the Fed's going to step back from any tapering. The Fed is going to continue to deliver huge amounts of liquidity into the system. The taper is going to be maybe elongated rather than truncated. Julie, can you kind of offset those two forces for me?
Well, I think at the end of the day, every one of us would prefer to have a strong economy rather than one that's simply supported by the Fed. We've really entered into completely unprecedented waters here. To call it just an experiment is like calling, having your parents over and giving them an edible during Thanksgiving, to keep things calm. That's an experiment, right? I'm in California, so I can say that. But I think we've never been in a situation like this, frankly, where we have so much liquidity, interest rates are so low. If we go back to 07, 08, 09, we had a huge housing crisis that was just based on low interest rates. So I think it's more important to think about the fundamentals because those are what drive long-term. Right now, valuations for sure are very impacted by interest rates. But I think all of us would just prefer to have a solid, strong economy rather than one propped up by the Fed.
Well, Julie, as you say, there's been a lot of liquidity. It's been very abundant, but the tap's starting to turn off. And you actually had Jan Hatzius over at Goldman Sachs publishing yesterday saying he expects the Fed to basically double the speed at which it performs the taper. Do you think that acceleration of tightening may be a mistake?
Well, it's hard, right? Because we don't know how the liquidity is going to really play out through. If you think about the rally and the amount of liquidity that we have, I think it's no secret that valuations are very high. And so there is a certain amount of cynicism around this rally, right? People want to be in the market and want to be on risk assets in case the recovery is stronger than expected. But then the minute there's a whiff of, danger ahead, we get a reaction like today where everyone pulls out. And so I think that's a reflection of the psychology of the market where people feel they have to be invested on risk assets, but are very quick to pull out.
Will they be as quick to go back in? I've been in the office for many hours now watching Kayleigh Lines on television, and the people that she's been talking to have generally sounded really positive. This is an opportunity. This is Black Friday. Normally I'd be shopping for stuff. I'm shopping for stocks today. This is something I want to step into rather than out of. Julie, what do you make of that reaction? Because it seems to be pretty universal, judging by the people that have come on our air today.
I think it's a reflection of the fact that everyone has seen lots of businesses that they want to buy, but they feel the valuations are too high. And so this is the kind of opportunity that they've been hoping for. And I think that makes sense if you're trading in and out of stocks. But, for us, we're long-term investors and our time horizon is 5 years, typically. Mm-hmm. So for us, this is maybe an opportunity for some quality names that may have been a little bit overvalued. Maybe we have an opportunity there, but it just generally depends on what your time horizon is.
Julie, as we speak, the 10-year yield has now dropped sub 150. We're at 1.495%. That is the lowest since November 10th. Where's your hedge? Is it bonds or is it something else?
Well, hedges are sophisticated things that I know nothing about as a long-only manager. But I think the best.
But what do you put in a portfolio to get a little bit more safety?
I think to get a little bit more safety, you get into businesses that can do well, even if there is a more challenging variant or if the economy recovers. Like a good one I would think of is an off-price retailer named Ollie's Bargain Outlets, which has actually been under some pressure because people are worried about the supply of closeout merchandise. But the fact is that having this much dislocation in the supply chain is a beneficial thing for them long term. And the extra benefit to them is that if there are shutdowns, because they're general merchandise, they'll stay open. So businesses like that that have kind of upside and downside potential, those are the ones we're really looking for.